Hey, it's Bill Gross, the LA probate expert. And Freddie Mac's deputy chief economist says, prepare yourself. The U.S. housing market is the beginning stages of the most significant contraction in activity since 2006. Should you be scared? I say no. Let's get into the data. Now, it is true that mortgage rates closed this week at new highs. And you can see that since the beginning of the year, they've just marched up and up and up. And in fact, this last little bit's a little scary because whenever a economic factor ends on a straight up, it's possible next week is worse and worse and worse, or it could come back and recover next week sometime. But you can see that we've been going up straight all year long, starting around 3%, and now with 30-year fixed rates at 5.85. Critically, up about over 0.25% just in the last week. Now, is the trend? I say I don't have a crystal ball. The truth is, I have a crystal ball. I bought one on Amazon. It doesn't tell me where the rates are headed. It tells me where we are today. It doesn't predict the future. I can't predict the future. If you can predict the future, you can predict the rates. But short of that, it's not going to work. What you can do, though, is look by historical standards and see how dramatic these prices are, these rates are. In fact, we would say that since 2009, we've now gone back to the highest rates, back to the 2009-2010 era. So all this time we've enjoyed lower rates, we're now back to where we were. Does that mean it's going to continue up? Don't know. But just even staying here is the top rates of the last, what is it now, 13 years or so. Significant. Now, if you look in the longer horizon, I've been in this business since 1986 when rates just came through 10%. So for this last 36 years I've been in business, it's been almost a straight downhill. Yes, we gave back some of it, but even if you drew a line over that time period, it's been somewhat straight downhill. So again, is it a trend forward? Hard to say. You can see along the way we've had bump up and down, bump up and down. It's always been a bumpy ride on the way down. I'm not saying that's where we're headed going forward. I'm just saying doesn't mean the fact that rates went up, they're going to be going up. It just means that they went up. And it's important to know the difference between comparing data where we were and predicting, therefore, where we're going to be. Famously, there's a quote about Wayne Gretzky that he was always skating to where the puck will be. Well, he's Wayne Gretzky, and in hockey, you can predict based on the players where things are going. If you can predict the future of the economy and predict the rates, then you can make a lot of money. Now, what I will say, though, is the real estate press does a terrible job educating us, and actually not even educating us. For example, one of the quotes, I think this is MarketWatch, one of the worst sources for exaggerating. It says, prepare yourself, and this is the title of my email that I draw from. The U.S. housing market is at the beginning stages of the most significant contraction in activity since 2006. Notice it's beginning stages. That covers them because if it happens anytime next 20 years, they're going to say it's the beginning stage. And they have this kind of ominous picture of all these houses, somewhat hardly, half built and some vacant. What's fascinating is when you look into the data, he just says it's since 2006. 2006 is when the market had been improving, started to slow down the improvement. It still continued to improve for another 2 years. What made the foreclosures worse was during that time, the government started forcing loan products that did not check income and credit scores or require down payments. And so when that flood of activity continued, instead of the market adjusting naturally, it would be like the government throwing gasoline on a fire on a house instead of letting it burn itself out. And that's what made things so much worse. So when he says 2006, it's an interesting number. Now, when you look at the data, the only data he points to is that purchase mortgage applications are down 40%. Sounds like a lot. However, keep in mind, last year we averaged about 11 offers per property. This year we're averaging about 5 offers per property. Down 40% would mean that we'll only have 3 offers per property. Does that mean that the mortgage prices are going to the home prices are going to go down? Does that mean we're looking at decreased prices? Absolutely not. And in fact, when you look at, this is Len Kiefer, the deputy director economist at Freddie Mac, paid a fortune by our federal government. When you look at what he really concludes at the end, he says, I don't think home sales are going to grind to a complete halt. They'll just slow down. People will still be able to sell homes, but it may just take a little bit longer than what it's been. It may take a little longer. So homes have been selling in 3 and 5 days will sell in 10, 15, 20 days. Is that so bad? So again, sometimes these reports, they sound terrible because they want to get you to click on the article and read the data. But if you're looking deep, you'll find it's not quite that bad. Another terrible article comes from, I'm a realtor, I'm ashamed of this one, realtor.com, our own magazine, our own website. And it has this very scary chart where it shows the active listings year-over-year change, and this is like each week. So what happens each week, they plot the prior year-over-year change. And not only is this number off the chart going up, higher than 2019 when the pandemic started, interesting, looks like it's going straight up and to go up forever. But this is just charting out week over week of our year's trend line. When you look at the data in context, I think, you'll see this little exaggeration here. This is what they're talking about, that listings went up. And over last year's number, listings are a bit higher. But listings are way below 2020, 19, 18. Way below. Way below. Very misleading information. In fact, Black Knight, which is a mortgage data servicing center, they even had looked at it even deeper. They show the historical numbers over time. This is the blip up down here. But you can see over time the inventory has continued to go down. If you can try to compare inventory levels to 2008 and 9, we're nowhere near that. We're nowhere near the level we could have foreclosures like the rates that we had previously. It's just not even possible. Black Knight says that they expect housing inventory to be severe, accelerating, chronic shortages in every market, in every price range. They see this as a long-term structural change in our market, unlike 2008 and 9, where at least in California, they're building acres of houses and people are buying 5 and 6 with no money down. That's not happening today. And they actually cite 7 different reasons why the inventory not only is where it is, but will continue to go down. And they'll keep a check on prices from collapsing. And they say, 1, increased informational efficiency. Whereas 2008 and 9, buyers didn't see the coming foreclosures that the professionals saw. Professionals, if you saw the movie The Big Short, were selling to buyers who didn't know what was happening. 2, accommodating fiscal policy. He predicts the Fed will continue to accommodate rates and help overall. 3, he predicts that remote work has pushed people out to suburbs. So we might have had price crashes in the suburbs like we did in the past. They were hardest hit in the outlying areas, not happening this time. 4, he says institutional investors are buying property and turning them into rentals. They got to put the money somewhere. That was harder for them to do in 2008 and 9. They started with foreclosures 2010 and 11. But now they're actually building properties, institutional investors are, for rentals. Number 5, he cites restrictive zoning, not just like we have here in LA and in California, but across the country, cities have been more restrictive in building more. If you build less, can't have the excess inventory. 7, supply chain issues we've heard about in every factor affects the building of houses. And number 7, rooted sellers. There are sellers who would sell, they were going to move somewhere else, but they can't now because the mortgage rates went up where they're going to buy, so they'll just stay where they're at. So there's even less inventory. So 7 functional reasons why inventory levels will not go up like they did 2008 and 9. Again, look at that chart and see where we were when we had the big correction of 2006. Look at all that inventory we had to have before we got into foreclosures. We're nowhere near that today. So what should you do? As always, you do you best. If you can afford to buy a house, and if you can afford the long-term payments, then you can also enjoy the long-term appreciation and tax benefits of owning a property, then buy a house. By all means, there's less competition now than before. Yes, the prices are higher than they were a year ago by 15% or so. Yeah, the payment's higher now. You can look at adjustable mortgages to lower your rate with an eye towards refinancing maybe the next 5-7 years. Or not. But you can buy now, whereas a year ago, we have buyers who bought now. I have one. He bought now because he couldn't buy a year ago. He got overbid, got into something that he's really happy with. So if you're a buyer and you want to buy now, you should buy now. And if you're not, don't buy in speculation. As a seller, it's still a great time to sell. Not as great as 6 months ago in terms of competition, but prices have still continued to go up. It's a little more balanced. It requires a better lender. I had a seller today who didn't pick me as a listing agent. They went somebody else. Now they're having some problems with contingencies. This is where professional realtors will help represent you and get a buyer who makes an offer to actually close the transaction so you can move and get on with your life. So at the end of the day, you do what's best for you rather than worry about what the market is doing and try to outguess the market. If I can help in any way, my contact information is down below. I'm Bill Gross, the LA Probate Expert. And as always, make this week your best week ever. Thanks so much.